Hi, this is Rajiv Sethi of the Economics Department at Barnard College, Columbia University, and the Santa Fe Institute, and I'll be speaking with you today about prediction markets. I'll start by describing what prediction markets are, how they are structured, how they work. Then we'll talk a little bit about what they're saying about the 2024 presidential election in the United States. We'll see how markets compare with models in terms of accuracy, and then I'll discuss some recent research that introduces something called a profitability test that can be used to measure forecasting performance of models relative to markets and also models relative to each other. And then we'll conclude by talking about some extensions. So let's start by answering the question of what a prediction market really is. One way to think about it is that it's a mechanism for aggregating the beliefs of a variety of different people. So if people have different beliefs about the likelihood of some future event, they can bet against each other. That betting or trading activity gives rise to a certain price, and that price can be interpreted under certain conditions as a probability. Specifically, a prediction market is a venue for the trading of securities with state contingent payoffs. What that means is that the assets or the securities that are traded have a very simple payoff structure. There's a referenced event, like the outcome of an election. If it occurs, then people who buy the security will get paid. And if it does not occur, then people who sell the security, who are betting against the event, will get paid. And they'll get paid a fixed amount. Otherwise, if you bet on the event and it doesn't occur, you get nothing. And these securities are sometimes called binary options or event futures. And one of the key features of prediction markets is that the contracts are liquid. Traders can enter, exit, and reverse positions in a matter of seconds. You can bet on an event and then you can exit your position and change your mind just a few seconds later. And the price may have changed, you may have made money in the meantime, or you may have lost money, but you don't have to hold until expiration. Now, there's something in prediction markets called a margin requirement, and this tells you how much money is held by the exchange whenever a trader buys or sells a contract. And usually the margin requirement is set at the worst case loss. That means that you have to deliver to the exchange an amount that is equal to the most you could lose based on the position that you're entering. I'll explain this with a few examples. And there are many traditional methods of evaluating forecasting performance, and one of them we'll discuss is the average daily Brier score. And historically, based on these performance measures, markets have been quite competitive with models. But like I said, we'll introduce a new way of evaluating performance, and we'll see how this does in comparison with these traditional measures. At the bottom of the screen, you'll see links to a few existing prediction markets. The Iowa electronic markets have been around for several decades now, from the late 1980s. Very simple, very rudimentary, but they have generated data for a long period of time. The most active market for election forecasting through prediction markets in the US is Predicted. And then there's a relatively recent market called Kalshi, where you have a large number of contracts traded. It's very heavy volume, but they don't reference election outcomes. So I'll be focusing mostly on Predicted. But before I get there, let's take a look at the Iowa electronic markets and what they're saying about the 2020 election. So here's a particular contract or a set of contracts. You can see on the screen Dem WTA and Rep WTA. WTA stands for winner take all. And the Dem WTA contract will pay $1 if the Democratic Party nominee, now that's likely to be Joe Biden, receives the majority of popular votes cast for the two major parties in the 2024 US presidential election. And if the Democratic Party does not receive a majority, then that contract will pay nothing. So you can see that it has a very simple payoff structure. The Rep WTA contract does the opposite. It will pay you if the Republican Party nominee receives a majority of the popular votes cast for the two major parties in the 2024 election. Now notice that this is a popular vote market. This doesn't tell you who's going to win or lose the election, who's going to become president, because it's entirely possible. In fact, it happened in 2016 and it happened in 2000. It's entirely possible that the candidate that gets a majority of the popular votes cast will not be elected president because of the electoral college system. Now let's just take a look at some of the prices. Now you can see here on the screen, you've got two columns, bid and ask. And let me just explain to you what these prices mean. So if you just take a look at the ask column and take a look at this price, 0.785. This tells you how much you would have to pay in cents, in dollars. So 78.5 cents would be the price of one contract that would pay you $1 if the Democratic candidate gets the majority of votes cast for the two major party candidates in 2024. If you wanted to sell this contract, if you already own this contract, for example, and you wanted to sell it, then the price that you would receive for selling it is somewhat lower. It's about 74.5 cents. So the prices to buy the contract and the price to sell the contract are not the same. The price that you would have to pay to buy over here is higher, and it has to be higher than the price that you would receive if you were to sell these contracts. And the last column, which is called last, that tells you the price at the last trade. So the last time there was a trade in this market, somebody paid 79 cents for a contract on the DEM WTA market, and the last trade for the Republican contract was about 24.3 cents. In fact, it was exactly 24.3 cents. And here you see a time series, the way in which these prices have changed over time, going back to June of this year. Going back to June of last year. So over the course of the past year or so, you can see how the prices have changed. And in this market, at least, the price of the Democratic contract has exceeded that of the Republican contract by varying degrees over the course of the entire period. That doesn't mean that the market is predicting that the Democratic candidate will win the election, only that it's more likely that the Democratic candidate will win the popular vote than the Republican candidate. Now let's compare those prices to the prices that are prevailing on a different market predicted. Here, the price at last trade for the Republican contract was 54 cents. The price at last trade for the Democratic contract was 50 cents. Now notice that these numbers don't add up to 1. They can't immediately be interpreted as probabilities. And part of the reason for that is that there's a fee structure in these markets. So sometimes these prices can vary from numbers that would make sense as probabilities. In this case, one way to deal with it is to look at the sum of the prices, in this case 104, and if you scale down each of the prices, divide each of the prices by 1.04, you'll get something that adds up to 1. And so one way to interpret what this market is saying is that the Republican candidate is likely to win the election with a probability of 52%, and the Democratic candidate with a probability of 48%. If we ignore the Libertarian and Green candidate, if we treat those probabilities as essentially being equal to 0. And again, you have buy and sell prices. If you wanted to buy a contract on the Republican candidate, it would cost you 54 cents. And if that person actually wins, it would be, you would receive $1. If they lose, you'd receive nothing. Similarly, you want to bet on the Democratic candidate, you would pay 51 cents for a contract that will pay you $1 or nothing. Now, notice that this contract is not referencing the popular vote. So there's no contradiction really between this market and the one I showed you earlier. In this case, the event that the market is referencing is the outcome of the presidential election in terms of who will actually win the race rather than who will win the popular vote. And those are two different events. And here again you see the time series. So over here you can see that a few days ago, around the 25th of May, slightly earlier than that, there was a change in leadership, and it's been fluctuating since then. And right now the market is roughly evenly divided in terms of how much probability is assigned to the winner being Democratic rather than Republican. And you can also see on this graph volume. So you can see that quite a large number of contracts are traded daily. The big spike in volume that you see on the 30th of May, about 30,000 contracts traded. That was in response to the outcome of the hush money trial in the New York City court system. And you can see, firstly, that the verdict led to a very active period of trading on this market, but at the same time did not really have much of a price impact. Now let's look at a different kind of market. So this is a market for the Republican vice presidential nomination. And this kind of event is much harder to model. So there really doesn't exist any reliable model of how the vice presidential candidate is chosen. It's a very idiosyncratic event, and it depends very much on the preferences of the person who ends up being the nominee of the party. And in this case, you see a whole bunch of different candidates. In fact, there are 15 more contracts that are not shown on the screen. And Tim Scott and JD Vance are the two leading contenders here according to the market. A contract, you can buy a contract that will pay $1 if Tim Scott is selected as the VP candidate. And it'll cost you 22 cents, and that'll pay $1 if he's selected. It'll pay you nothing otherwise, and so on. And roughly speaking, again, subject to the caveats I mentioned earlier, these prices can be interpreted, suitably scaled as probabilities. So this market is saying that there's about a 1/5 chance that Tim Scott will be selected and another 1/5 chance that JD Vance will be selected, and so on, right? It's a slight difference in probabilities. And then you have others. So if you look at Elise Stefanik, the last trade was at 7 cents, and that means that somebody paid 7 cents to buy a contract that will pay $1 if Stefanik is selected as the nominee. Now, if you look at the best price available if you wanted to buy this contract, and that here is shown as 9 cents. So you will not be able to buy at 7 cents a contract that references Stefanik as the nominee. It'll cost you 9 cents in order to do that. Now, where is this price coming from? Let's discuss that for a second. So what you see on the screen now is what's called an order book. So this is a collection of orders that have been placed by people which have not yet traded. They're waiting for compatible orders in order to be executed. So if you want to buy contracts that reference Elise Stefanik being selected as the nominee, there are 1,684 available at 9 cents. So you can buy a large number of contracts at 9 cents that will pay off $1 if she were to be selected. Where does this come from? This actually comes from people who have placed orders to buy the contract that pays off if she's not selected. So there's 1,684 contracts that have been placed by people already and that are waiting for counterparties to trade, where the person is promising to pay 91 cents for a contract that will pay off if she's not selected. So really what the exchange does is it matches these two parties. It matches people who want to bet that she will be selected, who would have to pay 9 cents, with people who are betting that she would not be selected, who would have to pay 91 cents. So the exchange will collect 9 cents from this person and 91 cents from this person, together receiving $1, and that $1 will then be paid to the winner of that bet. If Stefanik is selected, that $1 is then paid to the buyer of the contract, and if she's not selected, that $1 will then be paid to the seller of that contract. So the exchange bears no risk. This is what I meant by the 100% or worst case loss margin requirement. So again, to recap, each contract will pay $1 if the reference candidate wins, in this case Stefanik, 0 otherwise. If the contract is trading at 9 cents, a buyer will give the exchange 9 cents and the seller will give the exchange 91 cents. The buyer in this case faces a large gain with low probability. The seller faces a small gain but is quite likely to occur. And the extent of trade is going to be driven by differences in beliefs and risk attitudes. People who are very confident will place larger bets, people who have more money will place larger bets, and people who are more tolerant of risk will pay larger bets. And the market price is determined by the interaction of all these components. Now, suppose you were to buy a contract at 9 cents. As you can see, it's available. We just saw the order book, so you could do that if you wanted to. And suppose that after a couple of days, the price goes up, let's say, to 15 cents. In this case, you can then sell the contract for 15 cents, and you'd have made some money. And it could be that the person you bought the contract from is different from the person that you're selling it to. But in your case, you would have taken something that cost 9 cents and sold it for 15 cents. This trading process is referred to as a continuous double auction. Orders just keep coming into the market. They trade if they find a compatible order. And if they don't, then they just sit there in the order book until they're canceled or until they find a compatible order to trade with. And these orders that specify both price and quantity are called limit orders. And if they trade immediately because they are compatible with an existing order in the order book, they are said to be marketable. And if they enter the order book, if they don't trade right away, if there's no compatible order, they'll enter the order book and sit there and wait. They're called resting orders. and they'll wait for a compatible order to arrive, or they may be cancelled, right? The person may not be willing to wait, and they may decide to cancel the order shortly after placing it or immediately after placing it. Now, the question I want to address next is based on some recent research, and it relates to whether or not markets can be used for the evaluation of forecasting mechanisms. So what I'm going to describe is a recent paper that will be presented in a couple of weeks at the Collective Intelligence Conference at Boston. And it's written with a bunch of people, many of whom are former or current students. Now, if you think about models, there are many, many models that forecast elections and forecast disease prevalence and forecast climate and so on. So you have a lot of models that forecast events that will occur in the future. And of course, you also have markets, or potentially you could have markets. And they offer very different approaches to forecasting. The models are backward-looking in the sense that they are based on historical data. When you build a model, you do it based on past experience. You have to select your set of variables and you calibrate it using data and connections that have emerged in the data that you have seen historically. Markets are completely different. They are fundamentally forward-looking in the sense that anything that's considered relevant to the occurrence of an event can be incorporated very quickly into the market. Any model that a trader has in their head, no matter how bizarre, no matter how strange, how different from the existing models that are out there, can be reflected in the market price through the activity of that trader. So markets can rapidly incorporate information from novel sources. Now we can ask how the forecasting accuracy of these mechanisms can be evaluated. And I'll talk about some conventional measures, and then I'll talk about some novel measures. The conventional measures basically look at the probability you assign to an event compared to whether or not that event actually occurred or did not occur. And I'll describe this in some detail in a second. But one of the big drawbacks of these conventional measures is that they're insensitive to small leads or lags. So what does that mean? That means that imagine if you have two models, let's say model A and model B. And model A is able to predict today what model B is going to predict tomorrow. So model A is able to forecast changes in the predictions of model B. In that case, model B is essentially useless. You can figure out by looking at model A today what model B is going to say tomorrow. If model B didn't exist, it wouldn't really cost you anything. Model A, on the other hand, is extremely valuable. Now, if you looked at the data generated by these models, the predictions, over a long period of time, and you used conventional measures to evaluate them, these two models would look very, very similar. Their forecasts are only separated by 1 day, but they're otherwise pretty identical. You're going to have the same set of predictions, just separated by 1 day. And these conventional measures will indicate that these models have roughly similar forecasting accuracy. And in a sense, they do. But the timing of the prediction, excuse me. But the timing of the prediction is extremely important. And in this case, you might want a measure that captures the fact that model A is much more valuable than model B because it reaches the same conclusions faster. So based on this idea, I'm going to introduce something called a profitability test, which is based on a portfolio of a virtual trader that is endowed with model-based beliefs and some budget and some preferences or tolerance for risk. So the basic idea is the following. Imagine that there's a virtual trader or a bot that believes the model. So it looks at the model forecast and it believes it completely. And it has some funding and it has some attitude towards risk. And it looks at the market price and it will see a profit opportunity. It will either want to buy or sell the contracts. And suppose it engages in this trade. Over time, you can track the profitability of this virtual trader. And at the end of the day, you can ask whether the trader makes or loses money. If the trader who believes the model makes money, if it's profitable, then you can conclude that the model is forecasting better than the market. If the trader loses money, it looks like the market is forecasting better than the model. However, you can also use this to compare different models, and we'll do that by looking at which one of them is more successful against the market. So let's explain how this works. I'll do it with a particular implementation, a particular example that uses data for the presidential election of 2020 from The Economist. And that was working with a particular model that was developed by some researchers, Merlin Heidemans, Elliot Morris, and Andrew Gelman. It's a Bayesian model, and The Economist published daily forecasts of different states, individual states, for the 2020 presidential election. And we'll compare it to a different model, the 538 model, which also generated forecasts for the 2020 president. And we'll also look at 538 forecasts for the 2020 Senate, the 2022 Senate for particular states, and then a few races for the House of Representatives in the United States in the 2022 election. And the market data is going to be from Predicted, which I've already introduced you to, and we'll look at daily closing prices. And we'll construct a virtual trader that's going to look at the daily closing prices, that's going to look at the model forecasts, and will choose to enter or exit positions accordingly. And we'll scale the prices in order to make sure that they can be interpreted as probabilities in the manner that I described. So if the sum of the probabilities is larger than 1, we'll scale the prices down slightly, and if it's smaller than 1, we'll scale them up slightly so that they add up to 1. Now, we've been talking about dollars and cents, right? 78 cents to buy a contract that'll pay off $1. But the amount of trading these markets is very substantial. So over 58 million contracts were traded over 7 months for the 2020 election in just 13 competitive states. So the amount of trading and the amount of money that changes hands in these markets is not trivial, even though each individual contract references a very trivial amount. Now, the first question I want to look at is whether the models in the markets largely agree, whether they give you roughly the same predictions. And here you see that they don't. So on the left-hand side is the Economist model, and on the right-hand side are the prices from Predicted, and you'll see that the model and the market really disagree. On many, many states, the model was much more optimistic about the Democratic victory in Michigan, Wisconsin, Nevada, and Pennsylvania in particular, almost 100% confident that the Democrat would win those states. The market was much more cautious, much less confident that the Democrat would win those states. So this tells us that the trading activity is going to be quite vigorous. Our virtual trader who believes the model is going to be engaging in a fair amount of trading because the market prices will appear attractive to somebody who believes the model. So let's put this idea into action. Before we do that, let's see what conventional measures, like the Brier score, would say about the relative performance of these forecasting mechanisms, the model and the market. So let's consider the 2020 presidential election. We'll look at 13 states that were deemed to be competitive before the election. And let PIT denote the probability assigned in period T or date T to a Democratic victory in state I. There are 13 states, and there are a large number of periods, actually 216 periods for which we have data. The Brier score is defined, you see over here, the Brier score is defined as a mean squared error. So if Pi is the probability that you assign to the occurrence of an event, and Ri tells you whether or not it occurred. So Ri is equal to 1 if it occurs and 0 if it does not. Notice that if your probability assigned to it is close to 1, then your Brier score is going to be essentially 0. Your prediction is extremely accurate. And if the event occurs and your probability assigned to it is close to 0, then the Brier score is going to take a value close to 1. So lower Brier scores are better, right? It's a mean squared error, and lower Brier scores indicate better forecasting performance. And we can average across all these 216 periods to get the average daily Brier score for any particular state. And then we can average across states to see whether or not the model or the market performed better. Now, if we do that, you can see first the time series. So you can see that the Brier score for the market, shown in red, was lower, quite a bit lower at the beginning of the period, compared to the Brier score for the model, which was shown in blue, which is shown in blue. And over time, they converge, and then towards the end of the period, you see that the Brier score for the market, shown in red, exceeds that of the model. So the model is forecasting better towards the end of the period. What if we just take the average across all periods? You can see that over here, the model average daily Brier score and the market average daily Brier score are almost the same. There's a very slight difference in favor of the model, but there isn't a whole lot of difference. But this, as we saw already, this conceals significant differences in performance over time. So we want to try to think about an alternative performance criterion based on what I referred to earlier as the profitability test. So let's see what this says. So to understand how the profitability test works, I'm going to describe a very simple version of it. So consider just a single jurisdiction, a particular state, let's say, and suppose there are only two candidates, and we'll call them A and B. And suppose that a model generates a forecast at date t, and we call this PT, which is the probability that A is going to win this election. And let S be an indicator variable that denotes the outcome realization. S is equal to 1 if A wins, and S is equal to 0 otherwise. At the same time, you have a prediction market that lists a contract that pays $1 if A wins and nothing otherwise, and let QT denote the price of this contract at date t. So QT and PT are both forecasts of this event. PT is coming from the model and QT is coming from the market. Now imagine a trader who enters period T, with a portfolio which we call YT minus 1, ZT minus 1, and that is inherited from the previous period. YT minus 1 here refers to cash holdings, so this is amount of dollars that are held by the trader, and ZT minus 1 refers to the number of contracts held by the trader. This is coming in from the last period. Now, ZT minus 1 could be negative. If the trader has bet against the event, has sold contracts rather than buying them, in this case, ZT minus 1 would be negative. This is the number of contracts that are inherited from the previous period. And we let XT denote the number of contracts that are traded in period T. And if XT is less than 0, if it's negative, that will indicate that contracts are sold rather than purchased. And a key question now we have to answer is, how is XT determined? How does the trader decide how much to buy or sell based on the market price and based on the belief of the model, which is PT, and which the trader believes? Now here's a schematic representation of what the trader is doing, and I'll go through this before describing exactly how the trades are determined. So the inherited portfolio you see there on the left is YT minus 1, ZT minus 1. That's the cash and the contracts that are coming in from the previous period. You observe the model forecast PT and the market price QT, and based on this observation, you decide to trade. And once you've decided to trade, XT is the number of contracts purchased, you have an updated portfolio. So ZT, the new contracts, is going to be equal to your old contracts, ZT minus 1 plus XT. And YT is going to be your old cash position minus anything you pay to acquire the new contracts. And that payment will depend, of course, on the market price. And that's why you have an arrow this way. The market price is actually going to affect how your updated portfolio is determined based on your trades. So now let's discuss how XT is actually determined. Imagine that you exit period T with a portfolio YTZT. This is going to depend on your inherited portfolio and your trades. Now you can ask yourself the following question. What will this portfolio be worth at the end of the day if I hold on to it to expiration? It'll be worth W, which will depend on S. S depends on whether or not the event occurs. If the event occurs, then each of your contracts ZT will be worth $1. So your wealth at the end of the day, W, is going to be YT plus ZT. If S is equal to 0, the contracts will be worth 0. And so your wealth at the end of the day is just going to be equal to YT. Now, we assume that the trader is risk averse, and instead of maximizing the expected value of terminal wealth, maximizes something called the expected utility of terminal wealth, where the utility refers to an increasing and concave function of the wealth. And that is described here in this equation. Now, PT is the probability that the event will occur. If the event occurs, you're going to end up with YT plus ZT as your payoff. U of YT plus ZT is your utility from those payoffs. And then the second term, 1 minus PT, is the likelihood that the event will not occur. That's what the model is saying, and that's what you believe. And in that case, you're just going to end up with YT, and U of YT will be the utility of that terminal wealth. So this is the expected value of the utility of your terminal wealth, and this is what the trader is going to maximize. And this is what determines the trade's X. Now you can write this objective function explicitly in terms of X by just observing that YT is just going to be YT minus 1 minus whatever you pay to buy the new contracts, and ZT is just going to be equal to your inherited contracts and anything you add to that by purchasing XT, and so on. And so you choose XT just to maximize this expression. And you need some initial value, some initial portfolio, and we denote the initial cash position by Y0. And in the beginning of this process, this virtual trader has no contracts. So Z0, the initial amount of contracts that you have is 0. Once you have specified an initial portfolio, you can then iterate this process and you get the trading in each period that depends on the prices that are observed and depends on the inherited portfolio from the previous period. Okay, now implementation of this requires the selection of an initial budget and a preference function, and I'll be showing you results based on an initial budget of $1,000 for each state and an initial contract position of 0. And the preferences that we'll work with are referred to as log utility. It's a special case of a class of preferences called constant relative risk aversion, or CRRA preferences. And it's it reflects a particular degree of risk aversion on the part of the trader. And we can now ask whether a virtual trader endowed with model beliefs would have been profitable. And of the two models, 538 and The Economist, we can ask which one would have been more successful. So first, let's take a look at how this trader would behave for the state of Wisconsin. And here you see, this is based on a trader that believes the Economist model. Here at the beginning of the period, you see that the trader enters a negative position. That means they're betting that the Democratic candidate will not win Wisconsin. And they're doing that because the model probability assigned to the winning of that state by the Democrat is lower than the probability that is assigned by the market. P is less than Q. And so this virtual trader decides that they want to bet against the Democrat in the beginning. But after about a month, it flips. So the trader starts to then accumulate positions that will pay off if the Democratic candidate wins. And although there are a bunch of fluctuations, at the end of the day, before the election, this virtual trader has accumulated a large number of contracts that will pay off if the Democrat wins Wisconsin. Now, it turned out that the Democrat, Joe Biden, in 2020, actually did win Wisconsin. It was close, but he actually did win Wisconsin. So in this case, for this particular state, the trader made a profit, or would have made a profit. Here you see the 12 other competitive states, and you see that many states were similar to Wisconsin. So if you look at Florida, you look at Minnesota, you look at New Hampshire to some extent, and Pennsylvania, you see a similar pattern of trading. Initially, pessimistic that the Democrat would win, or at least pessimistic relative to the market, and eventually flipping and accumulating a large position. There are other states where the market and model don't seem to disagree much, so there isn't a whole lot of trading, or at least the positions fluctuate and are not departing very substantially from 0. You can see that in Arizona, for example, in Iowa, North Carolina, and Ohio. And then you see Texas, where for the most part, you're betting that the Democrat will lose. And that's your position also at the end of the day and on the eve of the election. Now, for each of these trading histories, we can calculate exactly how many contracts are accumulated all the way to the end of the day prior to the election, and whether or not they would have made or lost money. So let's take a look firstly at the states in which the bot loses a lot of money. So if you look at Florida, for example, and you'll see something similar in North Carolina, and to a lesser extent in Ohio and in Iowa. So just look at Florida for now. The winner was the Republican candidate, but the trading bot accumulated a large number of contracts, 1,351.73 contracts that would have paid off if the Democrat had won. Now, these contracts expire worthless, so the only thing that the trader is left with at the end of the day is the cash position, 339, which is what they were left with at the end of the day, and they make a loss. There's a loss of $660. Your initial 1,000 has dropped by about $660, and so you have made a negative 66% return. So that's a big loss in Florida. If you look at Wisconsin now, you see a different picture. This was won by the Democrat, and it's one in which the bot accumulated a large number of contracts, 1,484 in this case. Each of those contracts paid off and gave the trader $1. That is then added to the cash position, so you get something close to $1,600 over here for a total 57% return. And the overall return, you can see at the bottom of the screen over there. Let me just clear this up a bit. Let's just remove this. And you can see at the bottom of the screen, you get a 16% overall return for the model, which suggests that the model would have been profitable relative to the market, and at least suggests that the model was forecasting better than the market, this particular model for this particular race. Now let's compare the two models. So here we can compare the economist model and the 538 model, and you see that in different states, they have different forecasting performance. So the economist model actually made money in Texas. This is from June to November because we don't have April to November available for 538. So it's a slightly different forecasting period. But again, you see, let's look at Texas, for example. The economist model makes money. They bet against a Democratic victory, which you see over here, and make a small profit. Whereas the 538 model bet on a Democratic victory. They have a positive number of contracts and loses money. And you see a lot of differences here across states. So in some states, the economist model does better. In some states, 538 does better. But at the end of the day, difference is essentially negligible. You just end up with about 16% return for both these models. And you can see that the economist model was slightly more profitable, but it's just a rounding error at this point. Now let's look at House and Senate races. For the 2020 House, you see almost no difference between model and market. It's a 2% return overall for the models compared to the market. For the Senate, somewhat larger, 7%, and then the Senate in 2022, a much larger return. So the model lost money in Pennsylvania, or at least the virtual trader representing the model lost money in Pennsylvania, but gained so much in Arizona and Nevada as to have a very substantial return on those three races. Now, if we look at conventional measures of performance, like the average daily Brier score, you see a slightly different picture. So for example, if you compare the Brier scores of 538 with predicted for the presidential election, you see that the market actually outperforms the model. But the profitability test tells you something different. It tells you that the model outperformed the market for President 2020. That's the information you see right here. Also, for the House, you see that the Brier score for the 538 is larger. Let me just clean this up a little bit. Here for the House, you see that the Brier score, they're about the same, but 538 has a larger Brier score, so worse forecasting performance than predicted, but we saw that it makes a profit based on the profitability test. So the profitability test and the conventional measures, such as the average daily Brier, do give you different kinds of results. And which one is more suitable, which one is the more relevant measure or the more useful measure will depend on the application you have in mind. So let me conclude. So what I've done in this lecture is to introduce you to prediction markets, shown you how they work, and talked about some recent research that introduces a novel and dynamic evaluation criteria that uses markets really to evaluate model performance relative to markets and relative to each other. Now we can think of several extensions. We can think about other kinds of events, disease prevalence, for example, with COVID cases, hospitalizations, and deaths. There were a large number of models that were submitted to the CDC, and they disagreed with each other very substantially, kept getting revised very substantially. Now, we did not have a market that was exactly synchronized with these model forecasts, so we can't carry out this kind of analysis, but we can do so in principle. If we have markets and models that reference the same event, we can carry out this kind of exercise for other kinds of events. We can do it for weather events, temperature, rainfall, and so on. We can do it for economic indicators such as unemployment and inflation, and we can compare models to markets. Actually, Kalshi does have a large number of economic indicators for which you have prediction markets. We can think about tuning parameters. I gave you results with log utility and a budget of 1,000. We can tune these parameters and see whether or not the results are robust, whether or not you end up with qualitatively similar predictions. We can exploit the correlation structure embedded in models, and the paper that I described to you does contain a model of how you would do this. Many models of presidential election outcomes, for example, exploit the fact that different states are correlated with each other. If somebody is likely to win Michigan, they're likely to also win Wisconsin, for example. or more likely to win Wisconsin than would otherwise be the case. And one can generalize the model that I presented to you to have a virtual trader that takes into account correlation structure. And finally, what I showed you was retroactive. We looked at the prices and we looked at the model forecasts historically, and we hypothetically constructed a set of trades that a virtual trader would have engaged in. And one could do this actually in real time and have live updates even before the election occurs that looks at the relative performance of models and markets. And I'm going to stop there. I hope this was useful to you.